Hey everyone, welcome to the Legacy Lawyer Podcast. Hey Nathan, how are you?
Good. It's weird. It feels like it's been a year since you and I actually did one.
We haven't got to do a podcast together for a long time. So
Yeah,
this is
it used to be me and you every week, and now we're two ships passing in the night, and we have lots of other players involved in the podcast, and which is all cool. But when you said, "Hey, let's do a podcast on Thursday," I said, "I'm in."
which is awesome because Nathan's been sick and swamped, so he definitely wanted to be here.
Yeah, yeah.
Well,
Yeah, I'm getting
today
over some nasty summer cold. You're not supposed to get colds this time of year, but I managed to do it.
it feels like I get them in random times too. And like
Yeah,
not the winter,
it
like I'll get them weird.
was bad. One of the worst sore throats I've ever had. So I'm super glad to be back and upright, and to be here today. So let's do it.
Okay, we're going to talk about the 6 ways to reduce your taxes, which everyone is usually
Who
okay
doesn't
with
want to
that.
know how to do that?
Yeah. So by the end of this episode, you'll know about the 6 different ways you can do it, and you'll have some really good talking points to bring up to your advisors, whether it's your CPA or your tax attorney or whoever you're using to help you with your taxes, to see if you can improve your situation. But before we start, real quick reminder that this podcast is for educational purposes, and anything we say today cannot be construed and should not be construed as legal advice for your specific situation. Although me and Nathan are attorneys, we are not acting as your attorney in this podcast. So now that everyone knows that,
I like to refer to our podcast as edutainment.
edutainment, exactly, exactly, combining
It's
the
for
words.
educational purposes, but we will entertain you as well.
So I don't know if you've sold anything, Nathan, and you're like, hey, that's awesome. I'm going to sell this item. I'm going to have this money. And then I have plans to use the money. But then you do the tax math, and then you're like, maybe I'm not going to sell that. 'Cause,
I have not sold any highly appreciated assets recently,
yeah.
so I have not faced that. But um, a lot of people don't sell things because there's so much appreciation built up inside of it that they're going to get hurt
Yeah.
financially if they sell.
So I did this analysis a couple years ago for a rental property. We're like, hey, maybe we should sell this property. We don't really love it. Um, we were all like, yeah, I think we should do that. And then we ran the math. And after we ran the math and factored in the taxes that would be owed, we passed. We're like, no, we'll hold it. We'll just keep holding it. And
Yeah.
I'll probably hold it for a long time because of the taxes.
Some people hold things until they die so that they don't have to pay the taxes on
Yeah. So there are 6 levers or 6 strategies that you can use to reduce your taxes. So if you're holding onto an asset and you're like, hey, I'm only holding on to it because I don't want to pay the taxes, this episode is for you. If you have to sell something and you're like, this sucks that I'm going to have to sell this and I'm going to pay taxes, this episode's also for you. Or if you just are a high income earner, right? Every year you make really good money and every year you write a pretty good sized check to the IRS. This episode is also for you because we are going to break down everything that the tax code allows to reduce those taxes. So you can make decisions not based on the tax implications, but you can make decisions based on what's best for you. So, Nathan, we didn't go over any of this list before. This is a list I made.
it.
So, um, you're kind of like in the dark. Well,
A little bit. I can think of three of the levers kind of off the top of my head.
and I think the other three you could maybe say are subcategories of the three, but I
Okay.
feel like they're just enough different so they can be their own.
Because I was intrigued when you said you came up with three new ones. I was like, wow, this can be impressive.
So we can go in order, or we can go with just what is on your mind, Nathan. What do you want to do?
Well, I feel like you should maybe guide it just so that if there's a way that makes more sense than another, then we kind of follow the best flow for it. So
Okay, cool.
I'm
I
easy.
like it. Okay, you're good either way. We'll just follow my list. So the first thing that you look at is this is primarily related to a transaction that would trigger taxes. You're selling something usually. So the first thing you want to look at is there a way to structure the transaction so it's not a taxable event?
Okay.
So this is where lawyers are very helpful because they're the ones who are usually looking at, hey, you're going to sell this thing, but is there a way to sell it that doesn't trigger a taxable event? And the example that we use a lot in estate planning is when you are transferring a family business to maybe one of your kids.
Okay.
But you don't want to just gift it to them because you want them to pay you something for it. Well, normally when you sell a business, that's a taxable event, right?
Well, a lot of people, even if they're selling the business to their kids, that's going to contribute to their retirement. It's going to
Mhm.
continue to support them in some fashion, so they need to get something out of it.
Yeah. So instead of having your kids pay you and then you report that as taxable income, you can form a trust. And if the trust is formed correctly and you sell the business to that trust, um, that your kids are part of or in control of the trust, then it's not a taxable event to the IRS. Now, I won't go into all the complexity of the code section and how that works and what needs to line up. But if instead of selling it to your kid directly, you sold it to a trust for your kid, and just that change in the transaction moves it from a taxable event to a non-taxable event. And so we can kind of check the box of, hey, we got to reduce our taxes.
Yeah, I don't think like there should be like we should have some canned cheering or some people in the background because I mean what you said is pretty monumental to say you can go from selling a business where you would have had to pay a huge tax bill to not paying any taxes at all just by utilizing a trust. That's impressive.
So honestly, when I tell a lot of people about it, they almost don't believe me. Like, what? No, you can't do that. Like, yeah, you can do that. But you have to follow the IRS rules.
Yeah.
And it's not like it's a novel thing. It's actually like the rules have been in place for over 30, 40 years, and there's tons of IRS decisions on it and court cases, private letter rulings. It's not like a big secret, but
It's a vetted, tried and true, proven strategy if you do it right, is what you're saying.
yeah, the IRS's position on when the sale of an asset to a trust is a taxable event, the IRS's position on that is very clear. It's been hashed out over the years very clearly, and as long as you know what requirements IRS wants, it's not anything out of the ordinary.
Cool.
Now, that same strategy is often used by high net worth individuals that are trying to eliminate their estate tax. So if you're over 15 million, when you pass away, you have to pay 40% tax on everything over 15 million.
Hmm.
And so there's, and this is where a lot of this law got developed. There's a way for high net worth individuals to sell their assets to a trust, and that trust is not part of their estate, so they don't have to pay estate tax on those assets. And so when high net worth individuals started doing that, everyone was like, wait, so is the sale to that trust a taxable event for income tax purposes? And then the IRS had, the law was already there, but then the IRS had, said,
They
hey, well, this is
clarified.
what we think. Yeah, this is what we think the law says, and all the attorneys and all the tax professionals have adjusted for that. And so it's been going on, forever, not ever, but for pretty long time, my whole lifetime. So it feels like forever.
So would you be letting the cat out of the bag too much to tell us like the name of this strategy or the name of this trust?
It's kind of like, and that's the thing, like, there's not like a name of the trust per se in the code section, but there's like names that tax professionals or tax attorneys have kind of used.
That's what I'm getting at.
But the key is, a lot of people will refer to it as a certain type of intentionally defective grantor trust.
Okay.
Yeah, but it can be designed a lot of ways, but instead of designing the intentionally defective grantor trust to minimize estate tax, you're designing it more to minimize taxes on a sale of an asset.
So if people hear the word IDGT, that's not your annoying uncle
No, or your brother.
or your brother. That is an intentionally defective grantor trust.
IDGT, yeah.
An IDGT. So attorneys, we like to take long terms like that and make them into acronyms that we can pronounce. And we do it all the time.
Yeah. We'll create, the short version of the name. So, who wants to say intentionally defective grantor trust over and over again, right?
14 times in
Yeah.
a conversation. Nobody. But who wants to say IDGT? I want to say IDGT all the time because it's fun to say.
Yeah. Rolls off the tongue.
Yeah.
Number 2. We ready for number 2?
Yep.
So it's sister of number 1. I would call it a sister.
Okay.
And it's its own category because it's really not the same thing, because the first option, you don't ever pay the tax, right? The transaction happened, it never becomes a taxable event. The next one, all these are you're structuring the transaction so it doesn't trigger taxes at that moment, but later on the IRS will want you to pay taxes. So you're deferring the taxes. This is the perfect example of a 1031 exchange. So anyone involved with real estate knows this one. Nathan, so I don't do all the talking. What's the general idea behind a 1031 exchange?
So let's say that I used to live in Pennsylvania and I own 3 rental properties in Pennsylvania. And I moved to Utah, and I'm kind of a DIYer, so I don't love hiring a management company. I like to be able to go see my rentals. I sometimes have conversations with my tenants. I just like them to be local. And I start looking around, and I think, well, maybe I'll sell these rentals in Pennsylvania and buy 3 rentals here in Utah. Then I go talk to Michael Haslam, and he tells me that if I do that, I'm going to be paying ridiculous amounts of long-term capital gains taxes. So what he does next, though, is he says, hey, what you can do is you've already picked out those 3 rentals. If we do this right, you can swap those properties. You can sell the ones that are in Pennsylvania, and within a certain window of time, you can repurchase the same types of rentals in Utah and not realize the taxes from those transactions. So essentially what you're doing is you're just moving where that capital is invested and putting it into properties that are now in a location that you're more comfortable with.
But that profit that you had in Pennsylvania, or the gains,
is
Does
not
that go away
realized.
forever?
Does it go away forever? No, it's still built into those new properties.
Yeah. So
So
it's nice.
I'm deferring the taxation, right? I'm saying I don't want to pay the taxes now, and in fact, maybe my strategy is I'm going to do the 1031 exchange, and then I'm going to hold until I die, so that my kids get stepped up basis. Am I getting ahead of it?
No, that's
Okay.
exactly, no, that's
Okay.
a great time to bring it up.
All right.
So that's why a lot of people will hold real estate till they pass away
Yep.
because they want to step up in basis when they die.
Yeah. So we defer it, but maybe I intend to never pay it because I'm going to get it washed away when I pass away.
Yeah, so number two, deferring the taxes are, I think I love those strategies if the approach you're using and the defer, like you never really going to need to use you don't really ever plan to liquidate those assets and use them,
Mm-hmm.
right? Like
Yep.
1031ing from property to property to property, that's great if you never really need that to be truly liquid.
Yeah, they're cash flowing. So for me, it's a great. They're paid for. They're cash flowing to me every month. It's contributing to my support during retirement, and they're growing in value. Eventually, when that stepped up basis kicks in, those will pass to my children, and they'll have these nice assets that have no built-in gain.
Now, that's one example. So in our first category, right, like do the transaction in a way that's a non-taxable event. That was just one way to do it. We talked about the IDGT, but there's other structures.
Mm-hmm.
And same with deferring tax. 1031's our example, but there's other things like installment sales, um, charitable remainder trust. We won't go through all the whole list, but the tax code has
But
several
we
things.
will stop long enough to say that when we talk about charitable remainder trusts, we call those CRUTs.
Mhm. Or and we it's not it's not your IDGT, it's your CRUT.
There you go.
So number three is deductions.
I
Okay,
almost said it. I almost said it. I knew you were going to say deductions.
you know I was gonna go deduction. So if I sold my property, I'm now showing a $500,000 of additional capital gains income. I didn't do any of the other options to defer those taxes, then if I can create enough deductions on the other side to erase the 500,000 of gain, then I pay nothing, right? If I have a $500,000 taxable event, but I have $500,000 of deductions, they
How on
cancel crap.
earth? How on earth am I going to go out and just create $500,000 in deductions?
And that's where it gets kind of interesting. Like if I'm a W-2 employee, right, and I'm earning $500,000, I have a great salary, um, it's a lot harder for me to create deductions than if I'm a business
Business
owner.
owner.
Hmm. Yeah.
Yeah.
And a lot of people don't realize though that there's plenty of vehicles in both categories that works and the IRS allows. Um, but you do have to be careful because I've looked at a lot of different structures or arrangements or companies that say, hey, we have a program where you invest in whatever, right? Or you put your money here and it creates this deduction for you. There's
Mm-hmm.
one where like you set up an LLC and they trade in a bunch of foreign currency, and before it creates a bunch of losses for you. So those losses you take back to your tax return and show them as deductions. Those losses create deductions for you. Um, and I've never felt comfortable with saying that program would work really well. I know there's a lot of people who do them and have done them, but like it doesn't check all the boxes for me. And I think the IRS audit, it would be difficult to defend that strategy. So you do have to be careful, and I would say if it's not like an actual, if it's not an actual tax attorney that's vetted the strategy for you, you really you're really kind of taking a big risk by doing the program.
So I find a Instagram guru that is selling a program. I mean, I just think I bring that up because that's an actual thing that I've dealt
Oh, yeah.
with. And these people got hosed. I mean, hosed.
Oh
Not
no.
only like, not only was there, fraud and problems with the actual interaction with this individual, but the strategy was flawed. So I'd say this is a this is a rule that applies to any of the strategies we're talking about. You should be careful who's recommending it. You should be careful. Um, you should always, if it's somebody other, like Mike said, if it's somebody other than a tax attorney, and you feel like it's a really good idea and you feel like you really want to do it, at least, at the very least, go get a second opinion from a tax attorney. Take it somewhere completely away from the person that's promoting it or selling it or pushing it, and put it in front of somebody that's totally neutral, that knows the tax laws, and just cover your bases, because the IRS is the mother of all creditors, and you do not want to get sideways with them. They have and they will destroy people, like financially, if people have done things the wrong way.
And one of the big benefits of getting that extra opinion letter is if the IRS does come and they do an audit and they disallow your deduction, they say, hey, the way you applied this tax code, we don't agree with it. Um, there's interest and then there's penalties, right? So you if you might still have to pay the interest, right, on the
Oh, you'll
taxes you
always have to pay the interest.
yeah.
You're never taking the interest away.
But the penalties can go away if you can
Hmm.
show you relied on competent tax professionals.
Yep.
And now they don't have to, but generally that opens the door to allow that. And I usually have seen that they'll waive the
I mean,
penalty.
if you're showing the IRS that you didn't just recklessly go out and try something stupid,
'Cause
you actually had a good faith basis to believe that this was a viable strategy, then they look at that differently than somebody that's just throwing stuff at the wall, right?
yeah, yeah, or just well, this guy, on Instagram said this is what he does, and I copied him, and
Yeah,
now I'm
that's scary.
So let's give a good example of number three, okay? One
Okay.
that's solid.
All right.
So I am a business owner. I buy an office building to run my business in. Um, I paid $1 million for that building. I can do what is called a cost segregation report. That's where they go through and they look at everything in the office building that I just bought, and they determine what's actually like a permanent part of the building and what's could be removed, right? So like the cabinets could be removed, the carpet, and they go through and they segregate what's personal property versus real estate. And the IRS code section allows you to depreciate personal property differently than real estate. And so usually it's like 30 to 40% of the value that becomes categorized as personal property. And there's more technical terms, so I'm using kind of the common
Yeah, let's
term.
stay high level. We don't want to lose people.
I'm trying not to. So, for anyone listening, if you're a weeds person and you're like, Mike's not using the right word, it's okay. We're not going to use the right word. So basically, if I bought the property for $1 million and my cost segregation report comes back and tells me 30% of the building I can depreciate immediately, then I get to take about a $300,000 deduction that year. So, and now if I used a loan to buy the building and I put 10% down, so I used $100,000 to buy the building and it created a $300,000 deduction for me. Well, that's a pretty good, that's a pretty good reduction in my taxes.
Yeah.
Right. So.
Yeah, and that's not something that's, when I said how do you create $500,000 in deductions, that's a good way to do it.
Yeah, so that's one we see a lot. Now we have some that are proprietary that we have relationships with and have vetted and helped develop over the years that we're not going to obviously talk about in this podcast, but like we have others that are way more useful than that example, even though that's a really good example. And so you want to be able to talk to someone who's really good at tax planning and look at what other strategies are allowed for your circumstances to create those extra deductions. But that's a really powerful one. Like I've had it save clients a lot of taxes. So
we've used it to save money.
Yeah. So number 4, if you can't get a deduction, you know what's even better than a deduction?
A credit?
A tax credit. Yes. Because if I get a $300,000 deduction, well, that doesn't save me $300,000 in taxes, right? Because I might.
It's not a dollar for dollar thing.
If I'm in a 30% tax bracket, it's saving me $100,000 in taxes, my $300,000 deduction. So a credit is a dollar for dollar. So if I get a $100,000 credit,
you're saving literally $100,000 on your taxes.
Yeah. And this one's harder to come by. You have to kind of be in the right scenario. The code section is always kind of changing around what credits are available. But the example I'd give on this one is an R&D credit, right? So if you're a company who's doing research and development and you're putting money into that, they will give you substantial credits. So you'll see this sometimes with software companies. They're developing a new software, and because of they spent $1 million developing this software, they can apply and get $1 million tax credit. So when you see some of the reports like, hey, this company earned $1 billion and they paid almost no taxes, it's usually because they spent $1 billion in R&D too.
Yeah. So essentially what you're saying is that tax credits are, the reason they're hard to come by and you need to be positioned properly is because tax credits come about when the federal government wants to incentivize certain activities.
Yeah.
So if they want, for example, a big one for a long time was solar, right? If we want to create a big incentive for people to adopt solar, put solar panels on their homes and create electricity and put electricity back into the grid, then a good way to do that is to say, hey, we'll give you a tax credit for doing that, and offsets the cost of putting those panels and that system into your home. So it just depends on what the government is incentivizing at a given time, whether or not a credit's available.
Yeah, and I like that you brought up solar, because that's the one that we've seen a lot of people use over the last decade. Solar credits. There's been people have developed kind of solar programs more for tax planning than for the actual benefits of solar, and said, hey, invest in this solar farm or invest in this other, solar project, and you can get depreciation. So we already talked about that, right? Some deductions from depreciation, and you can get some tax credits, and when you combine those, it can really save you a lot of money on your taxes. So, but going back to what we said before, you got to vet those really carefully with a tax professional.
Absolutely.
Because, their goal is to usually sell the solar. So if if they're misunderstanding the code section, even if it's, not intentional at all, and I think most people wouldn't be intentional in that, like the buck's going to come back to you, right? Like they always everyone puts in their fine print, I'm not giving you tax advice or legal advice, but they really are.
Yeah. Yeah.
And so
I mean, that's how they promoted it. They promoted it by giving you tax advice.
they say this is not tax or legal advice, but it is. And so you need to check it.
Yeah, and the other thing that happens is entire industries get built around the credit structure, right? So I mean, you saw during those, and it's still happening, but I mean, there was a time where you couldn't swing a dead cat without hitting another solar company, and they were everywhere, and some of them were complete frauds, garbage. They do terrible work. They destroyed people's roofs. They caused massive damage on property and brought property values down, or they put in systems that ultimately didn't work, and they don't care. They got paid, and they moved on, and you're stuck with the consequences. So there's, again, always vet every aspect of it, not just the tax advice, but if you're going to pay somebody to put solar on your house, make sure it's a reputable company. Make sure that you do your homework and your due diligence, and you get references, and you check up and make sure.
Yeah, the tax planning strategies we're seeing the most is more like kind of like solar farms or like solar, like parking structures or solar storage units. And
Yeah, I have clients right now talking about converting a field, basically as part of a ranch at one point. It was grazing land. They're talking about converting it to a solar farm in Colorado.
yeah,
So, yeah, that's still raging.
yeah, and so just make sure you do your due diligence on it. But if it fits, right? If it checks all the boxes, the product's good, the tax application is good, the timeline good, and it's going to save you the taxes, then it can line up perfect and be an amazing strategy.
Absolutely.
So after we do our tax credits or our income, yeah, our tax credits, the next is, can we change what tax rate or tax category we're in? And we usually see this between ordinary income and capital gains rates. So if I'm a higher income earner, Nathan, let's say I'm making the highest bracket in our income tax bracket,
640 or something.
do I want to pay ordinary income or capital gains?
Oh my gosh, capital gains all day long. The wealthiest people in the world don't pay income tax.
So
They pay capital gains tax.
they pay capital gains, right? Because we don't want to pay the 40%, depending on what state you're in, right? Like Utah has a 4.5% state tax, and so you don't want to pay the 40-ish% ordinary income rate. The 25% capital gains rate sounds
Yeah, way better.
way better.
Way better.
And so this kind of links to number one a little bit, right? Can we structure this transaction in a way where we're paying capital gains rates instead of ordinary income rates? And if so, you should do that.
Absolutely.
A good example of this is S corps. Everyone talks about, oh, you need to be an S corp. And this is sorry, well, and that's a little confusing because this is an example going from capital gains to ordinary income, but this is an example of changing the category of taxes you're in. So
Right.
I clarify that. So if I'm taxed as a sole proprietor or a disregarded entity, then I have to pay self-employment tax
On every dollar that comes through the door.
every dollar, which is about 7.6%, 7.7%, right in there. If instead I'm an S corp, then my profits come to me without any self-employment tax obligation.
Yeah, so you're going to set a wage, pay yourself a wage, pay your self-employment taxes on the wage, and then take owner draws that are not subject to self-employment taxes. Don't misunderstand, they're still subject to income taxes, but they're not subject to that 7 point whatever percent self-employment tax.
Yeah, so I get people, hey, should I be an S corp? And like my quick response is like, well, how much money are you making in the business? But if you're not profiting, like you're not making at least, I draw the line at 30K. It's not worth the effort to set it up as an S corp.
It's also tougher. I mean, you got to be careful what your structure is, who's providing the service, or whether you're creating products or personal service. All that goes into whether or not it's a good fit to be an S corp.
So number 6. So this is the last one Nathan didn't know about. That was the one he knew about it, but he didn't know that was going to be on my list. And then my last one is, I'm going to call it shifting income to other taxpayers.
Cool.
Yeah. So if I am a high income earner and I'm in the highest tax bracket, if I can shift income to another family member, or potentially a trust that can pay at a lower tax rate than me, then that might be a good idea.
Just make sure they know that's going to happen.
So when they get the K1 is usually what they will get.
Okay, so they're going to know.
When they get the K1 telling them to report.
Maybe tell them ahead of time they're going to get a K1.
Yeah. And so one way to do this is you can put like a family company into a trust, and then the trust can send out some K1s to individuals, and they can report those. You can also add, so the reason, you can also just, add, so there's family LLCs, there's also like family trusts. Sometimes you use both, sometimes you use one, but bottom line is you use some type of legal entity and bring other owners into the fold, or bring other family members into the fold, and that allows you to allocate some of the income to them. If they're in a 20% bracket, then they pay only 20%.
Yep.
And you can not pay 40 on all of it. Again, you have to meet all the rules. Like the IRS, this isn't like hey, we're tricking the IRS. Like, you have to check all their boxes and make sure, they're really the appropriate taxpayer. But that's a great way. So we've had clients who built kind of family businesses utilize that a lot, right? Let's allocate the income to the right people.
Yeah, and I'd just say generally, and this probably goes without saying, but everything we're talking about is legal tax avoidance. Nothing that we're talking about is illegal tax evasion. There's a difference between legal avoidance and illegal evasion. Sometimes the line between the two is narrow, so you got to be careful that you don't. And that's where sometimes people go wrong, is they try to adopt a strategy and it's not done properly, and it turns out that what they did was illegal tax evasion. So, but none of the strategies we're promoting obviously are illegal, even though some people might go, wow, I didn't know you could do that. That doesn't sound legal. Like you said, people question whether or not it's legal to sell a business to a trust to avoid taxes. Yes, that's legal tax avoidance. That's not tax evasion.
So if you're considering a tax strategy and you want a second opinion, let us know. We love helping people figure out if they're going to save taxes or create a bigger problem for themselves. And we've also, spent a lot of time in our developing and researching and understanding what strategies work best for our clients. And so under these 6 different levers that you can pull to save taxes, there's 5 to 10 ways, strategies under those levers that you can use. And if you need help finding those and picking the right one, we love doing that. So we're here as trusted advisors to help. Nathan, anything to put a bow on this?
No, I like it. I think anybody out there listening either has a use for this or knows somebody that has a use for it. So please, if you're listening, share this episode. We'd love to help anybody that we can, and we'd love to make sure that people avoid the problems that can go along with not doing this properly. So.
Cool. Well, Nathan, it was awesome doing a podcast with you again.
It was good. It was like old times. Yep.
All right, Amity, we're good.
You've been listening to Legacy Lawyers with Michael Haslam and Nathan Croxford. We give you the juicy detail of cases that our law firm has dealt with. We take out the lawyer talk and legalese and show you what options some of our clients had to choose from to fix their situation. The effects of not doing planning can be devastating. We'll be back soon, but in the meantime, hook up with us on Facebook and Instagram at Voyant Legal. Call us at 801-951-0500 or send us an email at team@voyantlegal.com. And for commonly asked questions, hit voyantlegal.com/resources. We'll see you next time.